Hi, this is Randy Finney with Right Side of the Chart. This is a mid-session update for Monday, April 11th, 2022. It is 11:34 Eastern Time as I'm starting the video. Let's start out here with the equity markets. So I'm going to start bigger picture right now. This is a weekly chart, and the bigger picture, the key, probably one of the most significant developments recently is this rejection off the 200-day moving average. That's the 200-day simple moving average here in blue. You had a rejection when we first, after breaking it there, we made a back test and had a big leg down, followed by this second test right here. We tested it week before last as well as last week. That's right at the high. Hopefully you can see that in the video. That skinny part of the candle, the shadow up top, as well as that one. That means we came up intra-week and got rejected. By the end of the week, we closed down well below it after and follow through today. So that's it. Now, before I leave this, I'm going to go to the shorter term charts. I think for the day, we're probably done for now. A little bounce here. I just as an active trader, I still swing positions, still short the markets. Absolutely. Near term, I'll get to the short term charts in a second for those who like to game balances. But I want to just show you this. So, when you break the 200 days, that should be a heads up. These are some of the most widely followed moving averages right there. And obviously, it only makes sense that every bear market that's ever been, you drop below the 200 days, in all the big corrections in recent years. And so I want to talk about these, the fact we're still below those, and as such, that what it does for me is it helps to determine my bias. Like I said, I say this often. Some traders, just trade the charts. What's in front of you? Blah blah blah. That's nonsense. You have to have a bias because at any point in time you need to decide whether, let's say, a stock or the indexes are running up to resistance. Do you want to get ready to position for a breakout on that resistance, or do you want to short into or bounce back into that resistance? Things like that. So, overall, again, for swing and trend trading, you need to formulate, okay, are you in a bearish trend? And not only are you in a bearish trend, but there are many times, you guys know me, I call tops and bottoms. That's what I like to do. And so sometimes we can be in an extremely bullish trend, and I'll still then decide to short based on everything else on the charts. But then, as evidence builds, which it has done, that's my point. We topped back in November, and the Nasdaq is still in a downtrend, and I'm still treating it as such. And if it starts to take out things like the 200 days, well, then that makes me start to second guess my longer term views, and the fact that I think we're still going down to those additional targets on the weekly chart, which down here 300 is the next target on the, or 299 to 300 next target on QQQ. But let me show you something. Let's go back real quick and talk about the 200 days and just take a look at what's happened back there. So this was when COVID hit, and when COVID first hit, that was February of 2020, it came down, you checked, you had a strong bounce, tradable bounce off the initial tag of the 200s, then they were taken out, and it was a pretty quick swoon down. Remember, COVID, although a lot of the drop in the markets was priced into the charts, so technically it was there, but it was a black swan event, and it took the markets and the economy pretty much by surprise. So that's why you had such a very swift move down. And of course, it was over before, if you blinked, you missed it, because the Fed came in with a nuclear option after the S&P had fallen 36%, and then boom. But let's look at the other times where we've crossed below. Of course, just the big corrections or bear markets. That was the fourth quarter drop 2018. Took it out, we back tested it, just like this, that being, let's just say, November of last year in Qs. Now that we're going back to 2018 here, but you took it out, we back tested like we did then we had another leg down. It's almost mirroring that one perfectly. The initial leg, the breakdown candle, a couple weeks of back testing, followed by a pretty impulsive rejection and good move down from there, from the 200s, not the high point, because we went above it briefly. But that was about another 9% drop. And then we came back, and this is months later. These are weekly candles. We tested it again, same thing, that blue line, the 200, and then the big drop. So here's what I want to lay out. Well, first of all, no two corrections or bear markets are ever the same. Sometimes they have similarities at some points and then disconnect at others. So just keep that in mind. It doesn't have to play out this way, but typically, If you have that second test, which often you do, after the first rejection, at that point, once you get rejected, it becomes a little more clear to the masses, to the bulls. And when I say the masses, at any given point in time, you always have more bulls in the market, more people to buy. Short sellers are a smaller niche group. Not every trader or investor is comfortable with short selling. So most people just want to buy stocks. And then so the buy the dip crowd, after that second rejection, that's usually that POR, what I call point of recognition, and usually get a pretty swift drop. So that happened in 2018, right? Back here, go back to 2015, closest thing you had to it. You took it out there, you tested it, you actually got above it for a few months there, but then once you took it out again, that second time, you had a pretty big drop. And that from there, once it was taken out, you dropped about 14% below the 200. And again, there's not a lot of comparisons because we've been in a super bull market since the 2008-09 lows in the Nasdaq 100. But you can see that back here. Let me tighten it up a little. Here was our last real bear market in 2007 to 2009, and right here, the Nasdaq 100 took out the 200, came back there, tested it. It was above it for a few weeks, but not much. It couldn't put it in the rearview mirror. Failed it. Came in for another back test right there, right? So that was the second back test, and after that, look what happened. Once you got rejected there, after that second rejection, it was a waterfall type sell-off. So food for thought. Now I'll recognize that, and I'll adapt to trade it as close as possible. I'm going to jump down to the short-term charts now and tell you that look, we're still above. Waterfall selling is probably not going to begin until and unless we take out those recent lows in the market, Qs, SPY, all of that, and we'll do it. If we do it in the Qs, we'll probably do it the rest of the indexes. But nothing goes down forever. We're down. We were at the lows today about 2%. And if you look at the 5-minute chart right here, which I just jumped to, this is short-term stuff. This is why I reversed. You had a little divergent. Well, actually bigger. We had a small divergent low there, right there, right? Little small trend line break, and it led to a tradable bounce. Now the divergence that started at that point has grown even larger. So we have pretty good divergence on this very short-term chart. These are 5-minute candles. We have a big old gap right here. Gaps love to be backfilled, and they often are. So if there's a potential bounce target, bounce up here. Bottom of the gap would be your first target, about 345.50ish right there, and then a backfill the gap, and there's also potential trend line above. So I'm throwing this out right now. So for active traders that might want to game a short-term bounce, being that we're near-term oversold, down about as much as QQQ usually drops unless you're in waterfall sell-off mode. In waterfall sell-off mode, you'll know that when you see it. We're not in that anything close to that right now. You get those 3% and bigger down days, 3, sometimes even 4% on extremes. I've seen 5, and the circuit breakers start kicking in and slowing things down, so usually not going to be much more than that. But that's it. So there's near term, and I continue to speak to the trend trader and the longer term swing and trend traders that don't have the time or inclination or skill sets to actively trade, to try to game the rips and the dips and all the little, what I call minor squiggles, zigs and zags. Those ought to just sit tight, because again, what I just started the video on, you had recently had another, what I believe could prove to be a golden shorting op, that second back test of the 200-day moving averages and some resistance. So if you shorted there, or anywhere after, since we started pulling back, just have your stops a little bit above there. If you want to tight stops, you can lower them down to entry. It all depends on where you got in. Obviously, if you got in below the 200-day and you put it to entry, and we have another back test at the 200, you're going to get taken out. So I like a little bit north of those, and but again, it depends on your entry and what you're targeting. But there it is. There's your potential bounce targets. If hit, if we get a backfill of the a test, I'm sorry, the bottom of the gap, that's about from where we're at now, 0.7%, and then that's where that'd be a nice bounce target there, about 1.7% from where we're at right now, almost 2 from the lows today, and that would be, again, you got a little downtrend line on the 5-minute chart plus the top of a gap, so they could come in roughly together right now, and let those divergences play out, and then reverse back to short. And for you NQ traders, you also have a pretty decent positive, aka bullish divergence here on the 5-minute chart right there, setting up. There's your divergence line, and here's a nice, clean, fairly clean downtrend line. You have at least you can call that 2 there, 3, 4, 5 distinct reactions. At least 4. That one's a little shy of it, but close enough. And I think this is where you target right here. You have a reaction low there, a second one there, a third one there, and then we broke it, back tested, so there's another reaction, yet another reaction right there, and that is all on the 14,307-ish level. So just shy of that is what I think a nice bounce trade would be, and that roughly aligns with my QQQ bounce targets. That would be from from where we're at now, about a 1.6% bounce in NQ, and then probably back down again. If we carry through that level and get through there, I could tell you right now, I'll add another level. You have next resistance is about 14,421, in case you want to just trail stop up. And if, based on what I started the video with, I showed you where after a second distinct test, a couple months after a top was in, and or at least a couple weeks, several weeks to a couple months after the initial back test and rejection off the 200-day, that you often get some pretty impulsive selling. So, the key is don't get married to this bounce scenario. This craps out, and we just take out the divergences and keep heading down. Well, then that shows you something else is in play here, and we could take out the recent lows sooner than later. I'm going to add one more line. I'm sorry, guys. Some level stood out to me right here that should be marked, and that would be about the max bounce target right now that I would expect and like to see. This is a trading range right here. I talked about it before. We had two little whipsaws down through there. It got back into the range, broke down again. That set up this support level here. Boom, then we broke down, and so that again that's why that's the target right there. And then if we continue past there, I don't favor that. I favor this. And if just this happens, we never even make it that far. I have first resistance here to 14,132.50-ish plus the downtrend line. That would be quite bearish. If we just go on down, have another big leg down, take out these divergences, that will tell me the supply and demand dynamics have really shifted. From a few weeks ago, everyone was gobbling up all things tech, and then the junk stock or meme stock traders started getting in and playing around. GameStop, AMC, all these low quality stocks. But then boom, that's over, and at least for now. So that's that. Let's talk about crude oil real quick. Let me do an update there. CL. This is my weekly. That's a 10-minute chart. Let me go to this hourly chart here for you. And let me zoom in a little bit tighter. Let's go down to 1 month. It's been so volatile, we can just focus shorter term. All right, so we still have last update, I gave you this divergence here. I had crude falling to 93.64 support ish. Crude's volatile, so you can see these candlestick, all those skinny parts, the white parts, those shadows, aka tails when they're down below the candle. That's just due to volatility spiking through, but you can see all the bodies closed on, back on, or above that level there. And we had another reaction there, little brief spike below, and we're back above it now. So 93.64-ish support is still holding, and the divergences, this is your bigger divergence line. You have a little tighter divergence coming in here, and you have this downtrend line, which is still so your levels potential targets are still $98, which would also coincide with a run back up to the downtrend line. Probably get a reaction there, and if you can bust through that, I think we can run back up here to about that 104.56-ish level. These were the last short trade targets, which were hit there, and then we went long there a few times, and that's a pretty big level. So 98 for crude oil is what I'm looking at, and let me do the bonds. We'll kind of keep this one short. All right, so there is, as I made clear, I think there's, you typically don't get as much bang for your buck on short-term bonds. The way bonds work, the shorter the maturity, the less sensitive they are to changes in interest rates, and the less volatile they are. But there's a lot of cross currents with the long bond right now. The 30-year. There's on one hand we know rates are going up. The Fed's made it clear they've already started a rate hiking cycle with more hikes to come, and it's taken long bond up. Yet on the flip side is, will the rising rates equate to a slower economy, possibly a recession? Very likely. And if so, then that would bring rates down. So those are the cross currents, and bond traders are duking it out. We're coming up to those long-term levels, resistance levels, downtrend lines that I highlighted recently on the 30-year and 10-year bond. But remember, we already hit it on the 5-year, and so that's where I like the 5-year. And you have this beautiful, look how well defined that downtrend line is, and there's your wedge. That's divergence. That was where it was this morning. I mean, we're still right there. Let me just extend the divergence lines. That's it. This is a pattern that's ready to pop any second now, I believe. And if the markets can't rally from here, that's why I'm viewing these treasuries as a hedge. If we break down those divergences I just showed you on the 5-minute chart, fail to play out for a bounce, you're probably going to see treasuries being bought as institutions start to finally return to them as a flight to safety bid. So boom, that's going to pop the 5-year, run up T1, T2, you got them. They're there. You can see that's my max target at this time. T5 with a preferred sweet spot. You just want a quick run up. This is a pretty big resistance level. If we don't get reactions at T1 or T2, I put good odds on a reaction if and when T3 is hit. Again, these are futures, so they're inherently leveraged. And I also threw out 2 other leveraged ETFs for you on the 10-year and the 30-year in that post I got out to you this morning. But keep on, I don't believe, and maybe I'm wrong, if there is one that you know of, post it, but I don't believe there's a leverage ETF for the 5-year. You do have IEI, the ETF that targets the 5-year bond. But I'm not sure if they have a leveraged instrument for that. Only on the 10 and 30-year that I know of. So that's that, and I'll go over the others. So that hasn't broken out yet, but it looks like it's close. That was ZF. That's what I just covered. 5-year. Let me find ZN and ZB. Well, here's ZB, the 30-year. Same thing, ready to pop. Nice little wedge, well-defined trend line. This is really right here. That line should be changed. I'm going to drag it now, fix this divergence line. It should look like this. Let me move it here. Quirky little lines. Grab it the right place. Put it back over here, and that shows you this is your divergence line. There's your positive, aka bullish divergence. Last time we had it was right there, and it did play out, popped the trend line, but it didn't go very far. So I retasked these targets. We had hit, I think it was the first 2 targets, if I'm not mistaken, on the last trade there. This one has this nice little wedge there. So pop it up, T1, T2, T3, and T4, which at this point in time is my final target. That's ZB, and so if you're going to trade TLT or that the leveraged one I gave you there on that, just pull a chart of the futures and track that. There are free real-time futures charts on investing.com. TradingView, I believe, has them as well, and TD Ameritrade, maybe some other brokerage platforms if you have one of those and you want to track the Treasury bond futures, even if you're trading the ETFs or ETNs. And last but not least, let me find ZN. There it is, the 10-year. Same thing. These guys are all just ready to pop. You got these little minor downtrend line there. Divergence has been building. Divergence there from that point to that point on the PPO. Secondary trend line right there. Pop, T1, T2, T3, and at this point in time, my final target, T4. So really liking these guys. Think they're probably going to pop. It looks imminent this week, but until it does, it's a setup. And you can take it ahead. Sometimes I have. Sometimes I'll take patterns ahead. I'll starter positions if it looks a breakout looks imminent and likely, and then I'll add to if we do get the breakouts. All right, let's keep this one short. So there's the stock market, treasury bonds, and crude oil for you. And if anything else stands out, I'll get another video or some static charts out to you guys later today. This has been Randy Finney with Right Side of the Chart. Have a great day.